Welcome back to the deep dive. Okay, we've got this stack of sources you shared, and we're jumping right in today. We're going deep on, well, the really fast-moving world of online fresh food retail in China.
Right. And our mission here is basically to cut through all the noise, pull out the key insights from this material you sent, and just get you up to speed quickly and thoroughly.
Exactly. We're going to really focus on one specific model that keeps coming up in these sources, the front warehouse model.
hmm And specifically, looking at the two big players the sources highlight, Dingdong Maicai and MissFresh. We've got some detailed info here on how they run things and, crucially, their financials.
Yeah, and the timing is interesting, right? Because both were applying for US IPOs pretty recently, around the same time.
Although, as the sources point out, MissFresh, well, they had a pretty tough market debut, didn't they?
They did, which kind of throws a spotlight on the big puzzle these sources keep circling back to.
Yeah. You got this massive growth in the sector, but both Dingdong and MissFresh, they're consistently reporting pretty significant losses.
So the big questions are, why are investors maybe a bit cautious? And just based on the data we have here, can these models, these operationally heavy models, actually become profitable down the line?
That's the core of it.
So that's our plan for this deep dive. We'll try to get a handle on these business models, look at the financial reality, compare them a bit to alternatives like community group buying.
Which the sources also cover.
Right, and see what the future might hold. But strictly sticking to what's in this information you provided. Okay, let's unpack this.
Okay, so to set the scene, let's start with the sheer size of the Chinese fresh food market. It's just enormous.
Like, how big are we talking?
The sources say it hit 5 trillion yuan back in 2020.
Wow, 5 trillion.
Huge number. But here's the contrast. It's still dominated by, older ways of shopping.
Traditional channels like wet markets.
Exactly. Wet markets still accounted for, get this, 56.5% in 2019. That figure comes straight from the source.
Over half the market. That's way higher than in, say, developed countries, right?
Right. Oh, significantly.
Yeah.
The sources mentioned under 25% is typical elsewhere. So that gap, that's the massive potential everyone sees for online fresh retail. It's viewed as a key way to modernize things.
But it's not happening overnight. Even with all that potential, online penetration was still low.
Yeah, under 10% in 2020, according to the material. So huge opportunity, but still early days in terms of grabbing market share from traditional players.
And the sources suggest this shift, this modernization, it's going to be tough.
It seems so. They point to a couple of big challenges. One is the upstream supply chain. It's really fragmented. Think lots of small producers. Getting consistent quality is hard.
Okay.
And then there's the logistics. Urban logistics for stuff that spoils quickly. That's incredibly complex and expensive to manage well.
Right. So within this online space, there are different approaches emerging.
Yep, several models trying to crack this nut.
Yeah.
You've got your traditional e-commerce giants adding fresh food. You've got O2O, online to offline, store-based delivery, community group buying.
And the one we're digging into today, the front warehouse model.
Precisely. Which brings us to Dingdong Maicai and MissFresh. What's the core idea behind this model, based on the sources?
Okay, so the sources describe these Quanzi Kankan front warehouses, little distribution centers placed really close to where people live.
Exactly. Like within maybe a 3-kilometer radius,
Yeah.
the whole point is speed, ultra-fast delivery.
They promise delivery in, what, 30, 40 minutes?
That's the target, yeah. It's about bringing the inventory almost hyper-locally.
Okay. And operationally, this sounds intensive?
Very. The sources show they invest a lot in direct sourcing, trying to get better quality, more control. Dingdong, about 75% direct sourcing for fresh stuff. MissFresh reported even higher, 93% for fresh items.
That's impressive, but sounds costly, too.
It is. Then you've got managing inventory perishable goods across lots of small locations, maintaining the cold chain, and building out these huge fleets of delivery riders.
So when the sources call this a heavy model, yeah, I can see why. Lots of physical stuff, inventory risk, complex logistics.
Definitely heavy on capital expenditure up front. Warehouses, cold chain facilities, that costs money. And the inventory risk spoilage, loss, that's a constant headache you don't get selling, say, electronics online.
Makes sense. And building that direct supply chain itself must be a massive undertaking.
Absolutely. So Dingdong and MissFresh, the sources peg them as the top two in this front warehouse game.
Yeah, together they had over 60% of the market share by GMV, gross merchandise value, so total sales value in 2020.
Okay, so let's compare them based on the data we have here, scale-wise.
Dingdong was bigger in 2020, 130 billion yuan GMV versus 76 billion for MissFresh.
Quite a gap.
Yeah, and the sources make a point that Dingdong's revenue actually overtook MissFresh's in late 2019. And then during that first COVID surge, Q1 2020, the gap widened a lot.
Interesting. So the pandemic really accelerated Dingdong.
Seems like it. And they kept growing strongly into Q1 2021, revenue up 46%. MissFresh, on the other hand, their revenue was actually down 9% that quarter compared to the year before.
Okay. So maybe a tougher comparison base for MissFresh after the initial surge? Or just stronger momentum for Dingdong?
Could be a bit of both. Geographically, the sources say Dingdong is strongest in the Yangtze River Delta.
Shanghai area.
Right, while MissFresh is stronger up north, and both are mainly focused on those big first and second tier cities.
Got it. Now, let's hit the core challenge the sources identify, profitability, or rather, the lack of it.
Yeah, this is where it gets stark, both deeply in the red. Q1 2021 figures. Dingdong's net loss rate was minus 36.4%. MissFresh, minus 39.9%.
Wow, losing nearly 40 cents on every dollar of revenue. That's significant.
It is. And the sources note something interesting. MissFresh's total loss amount actually went down in 2020 compared to 2019, but the rate of loss got worse again in Q1 2021.
Okay. And Dingdong?
For Dingdong, both the total loss and the loss rate went up significantly in that period.
So neither was showing a clear path to profit in early 2021 based on these numbers. That high loss rate, that's central to the whole investor caution thing, right?
Yeah, absolutely. So let's look at the costs. The sources break down the structure for Q1 2021. Interestingly, Dingdong actually had a higher gross margin.
Yeah, 18.9% for Dingdong versus 12.3% for MissFresh. So Dingdong kept more from each sale before operating costs.
Okay, but then here's where the data gets really interesting, I think. Despite the lower gross margin, MissFresh's fulfillment cost rate was way lower.
Dramatically lower, around 10 percentage points less than Dingdong's rate.
How does that work? If fulfillment is picking, packing, delivery, shouldn't it be kind of similar?
Well, the sources dig into this. They calculate the actual cost per order to fulfill, warehouse staff, riders, etc., and found it was actually pretty similar for both in 2020, around 20 yuan per order.
Okay, so if the cost per order is similar, why is the rate so different?
It comes down to the average order value, the AOV, how much people spend each time they order.
Right.
Dingdong's AOV was significantly lower, around 66 yuan in 2020, and it dipped slightly to about 61.7 yuan in Q1 2021.
Okay. And MissFresh?
MissFresh had a much higher AOV, around 95 yuan in 2020, about 89.6 in Q1 21.
Ah, I see. So if it costs roughly 20 yuan to deliver any order, but Dingdong's order is only worth 60-something yuan, that 20 yuan cost is a much bigger chunk of the revenue.
Exactly. For MissFresh, with an almost 90 yuan order, that same 20 yuan fulfillment cost represents a smaller percentage. That explains the lower fulfillment rate.
Makes perfect sense. Did the sources suggest why the AOVs are different? Different strategies?
They suggest it might reflect platform strategies. Like MissFresh also has a supplementary next-day delivery service, which probably has higher minimum order values, and that could be pulling up their overall average. Dingdong might be more purely focused on that instant delivery, which maybe encourages smaller, more frequent baskets.
Okay. What about user behavior? Do loyal customers order bigger baskets, making them more profitable?
That's a good question. The analysis here shows core users for both platforms order way more often, like 2 to 3 times more orders per year.
Okay, so they're definitely engaged.
And they spend more overall per year, again, 2 to 3 times more than average users. But, and this is key, their average order value isn't much higher, only about 4% to 9% higher.
Interesting. So loyalty means ordering more often, not necessarily bigger shops each time for this rapid delivery service?
Seems that way. It suggests people use it frequently for maybe top-ups or specific needs, not necessarily a huge weekly grocery run. The sources mentioned Dingdong's Green Card members, about 22% of users, brought in almost half the GMV in Q1 2021.
Wow, disproportionate value from loyal users.
And they had high repurchase rates, like 64–70% still ordering after 1 or 2 years. So strong stickiness in that core group.
But even with sticky users, these continuous losses mean they're just burning cash.
Oh, definitely. The sources looked at their cash positions versus their operating cash outflow in Q1 2021.
Okay.
The estimate was Dingdong had enough cash and short-term investments to cover maybe 5 quarters of burn at that rate.
Okay, a bit over a year, and MissFresh.
Only about 3 quarters.
Oof. 3 quarters is not a very long runway.
No. It really highlights how critical continuous external funding is for them. They need it to cover ongoing losses and also to fund expansion, which this heavy front warehouse model constantly demands.
They can probably squeeze suppliers a bit, right? Like supermarkets do, pay them later.
Yeah, the sources mentioned they do benefit from that inventory turns over faster than they pay suppliers, which helps with working capital. But it's nowhere near enough to cover the scale of these operating losses. They need external financing, period.
Okay, so that's the deep dive on the front warehouse model from these sources. Heavy, fast, expensive, struggling with losses despite scale. How does this compare to the other big model mentioned, community group buying?
Right, community group buying or CGB.
That's right.
The sources consistently describe it as a significantly lighter model. Operationally, it's quite different.
How so?
Customers order via an app, often through a local group leader who might run a small local shop or just be active in the community. Then, crucially, customers pick up their orders the next day from that leader's location.
Ah, so no expensive last-mile delivery riders bringing individual orders to each door. The customer does the final step.
Exactly. And that fundamentally changes the cost structure. The sources describe CGB mainly as a consignment or third-party platform Model 3P.
Meaning the platform itself doesn't own the inventory?
Largely, yes. They connect buyers and sellers.
Yeah.
The inventory risk, like spoilage for unsold goods, is mostly borne by the suppliers until the customer actually picks it up. Compare that to the front warehouse model, which is mostly first-party, 1P, meaning they buy, own, and risk the inventory themselves.
Okay, lower inventory risk. That's a big plus. What about infrastructure?
Also lighter, according to the sources. Sorting happens in what they call grid warehouses. These are often run by third-party franchisees, not the platform itself. So much lower capital expenditure needed from the main CGB company compared to building out hundreds or thousands of owned and operated front warehouses.
Less upfront cash needed. And sourcing, is it simpler too?
Generally, yes. The sources suggest CGB relies more on local wholesalers rather than building those really deep direct relationships with farms and producers for everything, which is a big focus for the front warehouse players trying to control quality.
So lighter operations, less capital needed, simpler sourcing. Is it actually a bigger market than front warehouse?
Currently, yes. Way bigger based on these sources. They estimated front warehouse GMV was around 33.7 billion yuan in 2020. But community group buying, it was projected to blast past 200 billion yuan in 2021.
Whoa, that's more than 6 times larger. Why the huge difference?
A big factor mentioned is the aggressive entry of major tech giants into the CGB space in late 2020. They poured money in, accelerating growth massively.
Okay, huge scale. How about the financials? Are the CGB players actually making money? Or closer to it?
Generally considered closer. Now, overall loss rates could still be high, especially during that intense expansion phase. The sources mentioned one major player had rates around 30% in late 2020.
Still high, but maybe better than the nearly 40% for front warehouse.
Potentially. But the key difference highlighted is that in mature regions, where the initial land grab is over, CGB platforms seem able to control operating losses much better, maybe under 10% of GMV. That's a very different picture from the front warehouse players' consistent deep losses.
And why are their costs so much lower? Is it mainly skipping that last mile delivery?
That seems to be the absolute core of it. The sources estimate the fulfillment cost per item for CGB is incredibly low, like around 1 yuan, plus maybe 0.7 yuan per order for the group leader's commission.
Okay, compare that to 20 yuan per order for front warehouse.
Yeah, massive difference.
Huge. Even with the commission, the per order fulfillment cost is just vastly lower because they aren't paying thousands of riders for individual door-to-door delivery. The sources suggest that the current high overall losses for CGB might be driven more by temporary aggressive spending on things like marketing and recruiting those group leaders during the expansion rush, rather than the fundamental economics being broken in established areas. Right, spending to grow fast, which might ease off later. Okay, so we have these two really different models. Front warehouse, heavy, fast, pricier, focused on top cities, big losses. Community group buying, lighter, next-day pickup, cheaper, bigger scale overall, potentially closer to profit in mature areas. Do the sources see them as direct competitors? Like, will one kill the other?
That's a key question the material addresses. And the perspective presented in these sources is probably not. They argue for coexistence.
Why? Because they serve different needs?
Essentially, yes.
Yeah.
They fulfill different extreme demands, as the sources put it, and seem to target different customer groups and situations.
Makes sense. One's about, I need it now and I'll pay for it. The other is, I can wait a day for a better price.
Pretty much. Let's break down the differences highlighted in the sources. Price point. Front warehouse is estimated at around 120% of supermarket prices, so a premium.
Okay.
Community group buying, significantly cheaper, around 80% of supermarket prices based on some Wuhan data cited. That's a big gap.
Huge difference. Clearly targets different levels of price sensitivity.
Absolutely. Then speed and quality. Front warehouse is all about that 30-40 minute speed and often emphasizes higher quality through direct sourcing and cold chain control. CGB is next day pickup, focused squarely on value, maybe less on premium quality or instant gratification.
And the customer base reflects that.
Seems so. Front warehouse targets higher income folks in first, second tier cities who value the convenience and speed. CGB attracts more price-sensitive shoppers and does really well in 3, 4th tier cities and even smaller towns. The sources say about half their users are in these lower tier areas.
So geographically and demographically, they're not entirely overlapping, kind of complementary?
Largely complementary, yes. And the product mix differs too. Front warehouse is described as instant fresh food e-commerce, about 60% fresh items, wide variety over 4,000 SKUs, basically different products. It aims to cover most daily needs, even impulse buys, instantly.
Like a mini supermarket delivered fast.
Right. CGB is positioned more as next-day necessity e-commerce. Only about a third fresh items, smaller selection, maybe 1,000 SKUs, that rotate daily, focusing on basic planned purchases.
So less variety, more about planning for essentials.
Exactly. The sources also pour some cold water on the idea of easy logistical synergy. Front warehouses are built for rapid picking of individual orders. CGB grid warehouses are for sorting bulk orders going to group leaders, different processes, different transport needs, often different ownership structures.
Okay. So the verdict from the sources seems to be, despite some overlap as they both grow, their fundamental differences in operations, customers, and products suggest they can likely coexist. They're solving different problems for different people.
That seems to be the main argument presented here, which brings us back to the front warehouse model and its profitability problem. If they're likely to coexist, how can Dingdong and MissFresh actually start making money? What needs to change?
Right. According to the sources, what's the absolute key variable they need to improve?
The analysis is really clear on this, for both models, actually, but especially for the capital-heavy front warehouse one. The absolute linchpin for profitability is getting a significant increase in order density and overall scale.
Order density, meaning more orders coming out of each warehouse.
Exactly. More orders per warehouse, per delivery zone, per rider. Achieving that density creates scale effects that can improve profitability in a few key ways.
Okay, let's hear them.
First, gross margin. Just having higher volume gives them more clout with suppliers. They can negotiate better prices, lowering purchasing costs. And with more orders comes more data, which means better demand forecasting. That helps cut down on spoilage and waste in the warehouses.
Less waste, better margins. Makes sense.
Second, and probably most critical for front warehouses, fulfillment costs. With more orders flowing through each warehouse, those big fixed costs and rent for the warehouse space, equipment depreciation, maybe some core sorting staff gets spread over much more revenue.
So the cost per order for those fixed elements goes down.
Precisely. Now, the rider cost is mostly variable, one rider, one delivery. But the warehouse fixed costs are substantial. Making those warehouses sweat, basically, is key. The sources actually point to that Q1 2020 COVID surge as proof. Order volumes per warehouse shot up temporarily, and the fulfillment cost rate dropped significantly because those fixed costs were amortized over way more orders.
So they need to get way more people in each little neighborhood ordering way more often from their local front warehouse. That's the density challenge.
That's it in a nutshell. Drive density per location. The third area is sales and marketing. As they grow, hopefully get more market share and build that user loyalty we talked about.
Like those green card members.
Right. They can potentially start reducing the really high costs they currently spend on acquiring new customers and general advertising. Mature businesses usually spend less on acquisition as a percentage of revenue.
So it's about scale, improving margins, spreading fixed costs, and reducing marketing spend eventually. Are there other specific strategies mentioned just for the front warehouse guys?
Yes, beyond just get bigger everywhere, the sources emphasize they really need to boost gross margins specifically to help cover those high fulfillment costs, especially that last mile rider part.
How? Selling more expensive stuff.
That's one way mentioned, increasing the mix of higher margin or premium products. Another key strategy highlighted is developing successful private label brands.
Like supermarket-owned brands.
Exactly. The sources mention Dingdong's Oreo, Rishan, like Daily Fresh brand, as an example that apparently contributed significantly to GMV in Shanghai. Successful private labels can offer better margins than branded goods. They also need to keep optimizing how efficiently the warehouses themselves run beyond just volume, evidentially, yes, likely trim marketing spend as markets mature.
Okay, so it sounds like a complex puzzle. They need scale for density, density to lower fulfillment cost rates, better margins from sourcing and private labels, and eventually lower marketing costs.
Hmm.
It all sounds, well, really hard.
It definitely doesn't sound easy.
What are the big risks the sources flag that could derail this potential path to profit?
Several key risks are outlined. The most obvious one is just continuing to lose money, or losses getting even bigger. That's the status quo right now.
Yeah, number one risk, things don't improve.
Tied directly to that is the risk of not being able to secure enough future funding.
Yeah.
They need that external cash to keep operating and expanding while loss-making.
And MissFresh's tough IPO maybe highlighted that funding isn't guaranteed.
Exactly. It underscores that risk. Other risks include regional expansion just being slower or less successful than they hope. Remember, each new city means building out that whole heavy infrastructure again.
Right, it's not like software where you just flip a switch.
Not at all. Then there's intense competition. Not just Dingdong versus MissFresh, but potentially other front warehouse players plus CGB, plus maybe traditional supermarkets improving their own delivery.
And just the inherent risk of dealing with fresh food.
Absolutely. Product quality issues, spoilage, contamination scares are always a risk. That can damage your brand overnight and cost a fortune in recalls or compensation. Plus, challenges in managing supplier relationships and just sourcing enough good quality product consistently, especially as you scale up massively.
Okay. Anything else? Regulatory.
Yes, the sources mention the potential for increased regulatory scrutiny. China's tech and online retail sectors have seen tighter regulations recently, and that could impact things like pricing, promotions, expansion plans. And finally, a practical point. Just getting accurate data to really understand market size and dynamics is tough because everything's changing so fast and things vary a lot region by region.
Wow. Okay. So let's try to wrap this up. We've journeyed through these sources you shared, starting with China's massive yet traditional fresh food market. We saw the rise of online models, then took a really close look at the front warehouse approach, Dingdong, MissFresh understanding its speed, its heavy costs, and its current deep unprofitability.
Driven largely by those high fulfillment costs compared to relatively low average order values, yeah.
Then we contrasted that with the lighter, cheaper, next-day pickup community group buying model, which seems bigger overall and potentially closer to profit, at least in established areas.
And explore the idea, based on the sources, that they target different enough needs in customers that they'll likely coexist rather than one eliminating the other.
And the core challenge, especially for the front warehouse players, boils down to overcoming those huge costs and losses by achieving much, much greater order density and scale. That's the key variable highlighted for potential profitability.
It really seems to be the central theme running through the financial analysis in these sources. Scale and density are crucial.
It paints a picture of this huge market opportunity, but man, the path to actually making money, especially with that super fast delivery model, seems incredibly difficult. It requires enormous investment, relentless operational improvement, and maybe a bit of luck. So thinking about all this information from the sources, what does it mean for you, given the market size, the low online share, but the persistent losses even at scale for front warehouses? Does it just show how fundamentally hard it is to modernize fresh food retail in China? Or is this just the really expensive entry fee, the phase you have to burn through before the best operators finally figure it out and turn profitable? What stands out most to you from this deep dive?
A lot to think about, definitely. That balance between the promise of convenience and the harsh reality of the costs involved.
Indeed. Well, that's all the time we have for this deep dive.